a lot of these technologies can be applied in interesting ways. I think the big problem is not the technology itself in many cases. It's when the narrative around the technology is wrong or overstated, or you're trying to put the wrong type of energy source in the wrong area for the wrong reasons. I think that's where you get problems. But during that bear market, I kept watching. And when I saw the resolution of the block size war in particular, it was a really strong test for Bitcoin's immutability. And I also saw that Bitcoin's network effect at this point really matters. Basically, anyone can copy Bitcoin or make their own crypto, but you can't replicate the node network. You can't replicate the hash rate. You can't replicate the development that happens on top of it, the surrounding ecosystem. And so the combination of seeing that test of its immutability and in my view, hitting a certain network effect and scale really kind of pushed it over the line, and in my view, made it so that whatever the right position to have in it, I think the answer is not zero. I think what will be interesting is what Powell says in the press, because people are wondering the bigger question, the more uncertain question is, are they going to talk about tapering the rate of hiking? Right, they're still going to hike, but are they going to maybe start doing 50 basis point hikes going forward, or are they going to stick with very, very hawkish language? It's kind of the sad day of our times where the whole world stops and here's what one guy says that him and his council of elders are going to do with the price of money, and it has global implications, not just U.S. implications. But that's a state of where we kind of find ourselves in this very analog, manual, monetary world. So it's actually kind of a funny contrast to the automated global open network of Bitcoin. But yeah, so so far no surprises. So there's career risk where you know the downside of something can make someone not do it, whereas the upside makes them do it. So, for example, why was MicroStrategy the one that kind of went all in on Bitcoin? And it's like, well, Saylor has a very large stake of the equity in the voting rights, and so he's able to operate that almost like a small business. Whereas if you have one of those big companies where the CEO owns like a quarter of 1% of the shares, and he's kind of optimizing for quarter by quarter results and something like that, it's hard to make decisions that go against certain narratives or optics. But I do think that a shrewd energy company now should be looking into Bitcoin miners, especially in this time of stress, because I think the way this is going is we're going to see more and more integration between just energy producers and Bitcoin miners, right? Because the cheapest energy is energy that you produce yourself and then it's stranded or surplus, and you don't know what to do with it. And so you can you always have your own buyer, your own way to monetize stranded energy. And so I think that it's smart to get ahead of that. So I think the halving matters over time, obviously, but I don't think the timing is super useful for the specific kind of bottoms and tops of those big markets. I think liquidity is a much closer variable. I've done a lot of analysis on this. So if you look at PMI cycle, so Purchasing Managers Index, it's kind of a measure. If I look at one macro chart for a country, I want to look at its PMI, which is, Purchasing Managers Index. If it's rising, it means the economic growth rate is accelerating, and if it's falling, it means it's decelerating. And if it goes below 50, it means it's probably outright contracting. And so economies go through these ebbs and flows. And generally, Bitcoin does very good in rising PMI environments, and most risk on, quote unquote, risk on type of assets do well or better in the rising PMI environments, whereas Bitcoin generally does historically pretty poorly in falling PMI environments. And generally, the types of investments that do well there are defensive types of equities that are less economically exposed. But then when you dig in deeper, you find that liquidity corresponds heavily to PMI, and Bitcoin is even more closely associated with liquidity. And one simple way to measure that is to look at global M2, or let's say M2 of the top 5 countries, for example. Kind of pick your sample, but basically a large section of global M2, which is broad money supply, and then you denominate that in dollars. And if you chart that in rate of change terms, like year-over-year percent change, and you run that next to Bitcoin, especially in year-over-year percent of change terms, you'll see pretty strong correlation. So basically Bitcoin has not been acting as a hedge against quote unquote inflation like CPI, but it actually is a very, very strong hedge against global growth of broad money supply in dollar terms, and then it does poorly when that is decelerating or especially when it's negative year over year. And that makes sense because that's kind of a liquidity driver for everything. And what determines that? There's two main variables to determine that. One is how much money printing is happening among the major powers, and then also how strong is the dollar relative to other currencies. Because when you denominate all of that in dollars, if the dollar's stronger, you can get flat M2 even if most M2s are still kind of going up. But if you put it in dollars and the dollar like went up like say 10, 15% that year, you could get a flat figure, and that's generally a bearish environment for Bitcoin. And so I generally find that to be the strongest correlation that when money supply is growing, when liquidity is abundant, generally Bitcoin does well, pretty strong correlation. And then when that's all tightening and pulling back, that's when Bitcoin tends to struggle. It's not my base case, but it's a reasonable probability. But I think it'll be different than Great Recession, right? So I think this is more similar to the 1970s or the 1940s, or even the 2000s after the dot-com bubble. And it's very different in my view than 2008 or say 1929. So what 2008, what the Great Recession and the Great Depression had in common is that the implosion was mainly in private leverage and especially in banks, right? So both of those had just epic banking crashes. They were undercapitalized. They had a lot of loans relative to the monetary base, and so that was like a private sector implosion of debt. So what we're seeing now is quite the opposite, which is that banks have a very high allocation to safer assets. Obviously, it depends on the bank. There's some trouble spots in Europe, for example, but talking about say North American banks, they're much more capitalized and much more allocated as a percentage of their total assets to things like cash and treasuries compared to riskier loans or securities that can have a higher chance of defaulting nominally. And so I think that looking at 2008 is like fighting the last battle, and that there's problems now. In some ways there's bigger problems, but they're different problems. So I think the problem now is more at the sovereign level, at the currency level, right? So Japan has too much debt, Italy has too much debt, United States has too much debt, UK has too much debt, multiple countries in the world have too much debt, and so they are in a situation where they have trouble raising rates to suppress inflation sufficiently. And so I think that a lot of the pain is going to be in bond and currency markets. We've already seen that. That's already what made this different. And that's not a great environment for like unprofitable growth stocks, right? So if you look at when you entered the 2000s decade, after you got out that bubble, you had a more inflationary, commodity-driven environment. And if you looked at the S&P 500 did terrible, but that was driven by the NASDAQ type of stocks that were crashing. Whereas if you looked at REITs, if you looked at energy companies, if you looked at, kind of more value type of stocks, let's say healthcare, they generally didn't go through the same type of chaos that the technology sector did. And I think we're kind of in a similar environment where because it's more inflationary and because the challenges are more on commodities and interest rates and sovereign bonds, it's just a very different environment. It's a more stagflationary type of environment rather than like a deflationary environment. And so I think there are better analogs than the 2008 crisis.